I'll be going through with you Chase stock. This stock is JPMorgan Chase, and just type it in Google and you'll get the information. Now, just from Google, you can see that the full name is JPMorgan Chase and Company. It's JPM is the symbol, and if I want to buy right now, I have to pay 112.94 US dollar for one stock, and at this moment, 2nd August, and the market cap is in billions, so it means it's a big size firm. It's paying a dividend yield of 2.83%. If a company is paying dividend, that means they are financially very strong, because after paying their costs, liabilities, creditors, they still have extra money left. That extra money they pay to shareholders as dividend. So that means, any company that is paying dividend, that means they're financially very strong. It's a positive sign. Now let's have a look. When was this founded? I can see from Wikipedia that I can see this box here, and I can see that it was founded in 2000 and 18 years ago. And then let's go back, and I want to see what the employees who work here think about this firm. Let's copy this from Google exactly and paste it here and type in Indeed and reviews. Okay, just one sec. Review, and click here, and let's see what employees say about this firm. So we have 23,000 reviews approximately, and it's nearly 4 stars, which is brilliant. And you can just read through the pros and cons yourself, what people think about it who work here. Just check out the salaries they're paying to the employees, the photos of the firm, the jobs, the questions they ask. And let's have a look at Glassdoor as well for reviews. And I'll just have a look, and I can see we have 18,000 reviews, and it's nearly 4 stars, 3.8 star. And just read through the pros and cons yourself, and the jobs they have listed, the salaries they're paying, the interview questions, the benefits they are giving to their employees, the photos of the firm. Just to know about the firm, just go to just your patents and have a look if they have any patents or not. Let's just paste in the search bar, click enter, and I can see that I'm not interested in inventors, because these are people who invented but they don't have full rights. Just look for applicant or assignee, because these are people who have full rights of the patents. So we can see that in 2006 they have a patent, 2000 they have a patent, 2002 they have a patent, 2007, and stuff like that. So there's a big list, but please have a look if they have recent patents in 2015, 16, 17, 18, because that means they're still innovating. They haven't left innovation, so which is brilliant. And the more patent a firm has, the more stronger it is in the market. So it's a brilliant news. So go through it yourself. Now let's go to Yahoo Finance and see the key executives of the JP Morgan. Let's have a look. Paste it here, and that's the symbol we're looking at. Okay, JPM and profile, and we are looking at the financial services is the sector, industry, and the employees. And you can see we have 5 key executives, and all of their salaries have been shown. That's brilliant, because they haven't hidden any salaries, and it's much more transparent, and we can build trust with them. Now let's go to microtrend and compare the ratios. Click price ratio, price book ratio, and paste or type in the symbol JPM. Click there, and I just want to explain that if the price book ratio is less than 1, that means stock is at discount, it's cheap, it's undervalued, it's a sale, so you must buy it that time. If it's less than 1, if it's more than 1, that means stock is expensive. The higher the number goes, the more expensive it gets. Right now it's 1.41, which means if somebody buys the stock right now, they will be paying 1.4 times more money. So it's a little bit more expensive. But if somebody bought in 2016 September, they would have bought the stock at discount, because it is less than 1. It's 0.88 is the price book ratio. And if you see vertically up, the people who bought in 2016 September, they paid $62 to buy something that was only $71 worth. So they got it like nearly 12% discount. So that's brilliant time to buy. But it was lowest in 2011, when people got 50% discount, because they paid $24 to buy something that was only $47 worth. So they got 50% discount in 2011 September. That's brilliant news. But right now it's 1.41 times more expensive. So you need to see if you want to wait for it to come down, or you want to buy right now. So it's up to you to decide. Let's go to other ratios and click current ratio. Current ratio tells me if the stock is risky to buy or not. If the ratio is less than 1, that means stock is very risky, because liabilities are more than assets. And if it's less than 1, If it's 1.5 or more than that, that means stock is safe. It has good margin of safety, so you must buy it. If it's more than 1.5, right now it's less than 1. That means stock is risky, because it means that if you look vertically up, the liabilities are more than assets, which is not a good news. It's a risky stock. Let's look at the previous ones as well. So we can see a lot of risk, because it's like for a long time, since 2009 up till, I would say, up till 2015, it's always been less than 1. So it means the liabilities has always been more than assets since this period. So since we have data 2005 up till now, it has never been 1.5, so it's a risky stock, and most of the times the liabilities are more than assets, so which is very risky. Let's go to debt equity ratio. This ratio will tell me if the firm is mainly operating on debt or equity. We are looking for zero point 0.5 or less than that. It is more than 0.5, which means stock is risky in terms of debt as well. And you can see vertically up that the equity is and you can just see what's up that the equity is less than long-term debt. So the company is mainly operating on debt. This is a risky stock. Let's look at the previous ones. It's a very risky stock, because it has the debt has always been above equity. So since we have data 2005 up till now, the debt is always been more than equity, which is very dangerous, and we can never see zero point 0.5 or less than that ratio. So it's a dangerous in terms of debt equity. Now let's look at return on equity. We are looking for 8% or more than that for it to be ideal. Right now it's more than 8%. It's brilliant. Let's look at the previous trends as well. And I can see that it's fluctuating, but since 2010 June, it has always been above 8%, except once or twice, which is fine. But it has given me 8% return always, so which is brilliant.